Welcome back, Focus Learners. Okay, so today we're diving into a genuinely fascinating situation over in the utility sector. We're looking at Xcel Energy, ticker symbol XCL. We're going to do a completely objective, data-driven breakdown of their financial health right now. But honestly, the really exciting part, we're going to weigh their absolutely massive growth catalysts, which, as you'll see, are being driven by some insane macro trends, weighing all that against the very real systemic risks that come with running a utility these days. Let's get right into it.
Okay, let's dive into this. Here's our roadmap for the explainer. We'll start with a financial snapshot and valuation, then look at their $60 billion capital plan, how data centers are driving growth, managing debt and equity, and finally, wildfire and execution risks.
Section 1, Financial Snapshot and Valuation.
Right, so before we can figure out where Xcel is heading, we really need a solid baseline of exactly where they stand today. Basically, what we have here is a mature, heavily capitalized utility company. Market cap sitting right around $49.14 billion. They're trading at a PE ratio of 22.68 and delivering a return on equity of 8.82%. Oh, and for you income-focused folks out there, they've got a pretty solid dividend yield sitting at 3.01%.
Now, zooming in on their recent Q1 performance, there's a really interesting dynamic playing out. Their ongoing earnings per share ticked up to 91 cents, mostly thanks to higher electric revenue. But if you look at their GAAP earnings per share, the strictly generally accepted accounting principles number, that actually sat a bit lower at 89 cents. Now, what's really interesting about this slide is exactly why those two numbers aren't matching up. Basically, Xcel backed out a couple of key items from their ongoing earnings. First up, there was a 4-cent per share operational charge tied to Prairie Island. But offsetting that slightly, they actually had a 3-cent per share gain from increased insurance proceeds related to the Marshall wildfire. It really just goes to show you how these day-to-day operational events and insurance recoveries are constantly tugging at the bottom line.
Section 2, the $60 billion capital plan.
Okay, baseline established. Now, let's talk about the future. And for Xcel, the future is pretty much defined by this one number outlined by CEO Bob Frenzel, $60 billion. I mean, just think about the sheer scale of that. This is their new 5-year capital spending plan, and it is by far the largest capital program in the company's entire history. It's a massive, massive pivot toward infrastructure expansion. So I know what you're thinking. Where exactly is $60 billion actually going? Well, according to reports from Utility Dive, it's an incredibly aggressive portfolio built. We're talking 7.5 gigawatts of new renewable generation paired up with 3 gigawatts of gas generation just to ensure reliability. Throw in 1.9 gigawatts of energy storage, 1,500 miles of absolutely vital high-voltage transmission lines to wire it all together, and this is absolutely crucial, $5 billion dedicated specifically to wildfire mitigation. And this isn't just throwing money at the wall. The strategy here is super intentional. CFO Brian Van Abel pointed out that this spending is heavily front-loaded. They are sprinting to get this generation online before 2030. Why the rush? Well, 2 reasons. First, they want to avoid the tax credit cliff and really maximize those federal incentives for their customers. And second, they literally just need to beat their competitors to the punch to secure resources for this crazy surge in customer demand.
Section 3, data centers driving growth. Which naturally brings us to the big question, right? Why is demand growing so fast that a utility company suddenly needs to spend $60 billion? The answer, as you might guess, is tech, and this brilliantly illustrates exactly what's happening. If you break down their projected 5% retail sales growth through 2030, a jaw-dropping 60% of that is coming singularly from data centers. Another 30% is from oil and gas electrification down in their SPS region. Traditional residential and general electrification, that's just 10%. So essentially, AI and cloud computing are completely rewriting Xcel's demand curve.
The sheer scale of this is, honestly, almost hard to wrap your head around. Xcel already has 3 gigawatts of data center load fully contracted or at least tagged as high probability. But it doesn't stop there. They are tracking more than 20 additional gigawatts of active interest in their pipeline across their territories. I mean, 20 gigawatts, that is huge.
A perfect example of how this plays out in the real world is their recent deal with Google. We're talking about a 15-year contract requiring 1,900 megawatts of new wind and solar, plus, and this is super cool, cutting-edge 100-hour iron-air batteries for long-duration storage. But here's the kicker. Google is actually funding the infrastructure. Xcel estimates this will save their other customers up to $1.5 billion over the life of the contract. It's pretty much the ultimate template for how they want to handle all this explosive growth going forward.
Section 4, Managing Debt and Equity.
Okay, so the demand is obviously there, and the plan is clearly in place. But now we really need to pivot to the financial mechanics of it all. How in the world does a regulated utility actually pay for this? I mean, how do you pull off a $60 billion build-out without totally destroying your balance sheet, diluting your shareholders into oblivion, or just getting slammed with credit downgrades?
Well, management actually has a very specific rule of thumb for this exact problem. CFO Brian Van Abel explained that their base plan for funding incremental capital expenditures is to use roughly 40% incremental equity. That's basically their magic formula for maintaining financial health while navigating this really extended high-growth cycle.
So the crucial point is figuring out what this does to their current leverage. As of right now, their debt-to-equity ratio is sitting at 1.60, with net debt to EBITDA at 6.49. Now, Vanabel fully acknowledged that during a massive build cycle like this, their credit metrics are absolutely going to face some pressure. S&P Global even pointed out in their reports that this revised spending plan will definitely test the durability of Xcel's financials. They're going to be keeping a really close eye on that long-term 17% cash flow from operations to debt target. But to their credit, management isn't just sitting around waiting to see what happens. They are being incredibly proactive. We are only one quarter into this 60-month plan, and they've already addressed over half of their $7 billion base equity need. They've executed over $1 billion in equity forwards and issued $800 million in junior subordinated notes. They're essentially locking in the financing right out of the gate to de-risk the execution down the line.
Section 5, Wildfire and Execution Risks. All right, we've talked about the massive upside, but we really have to balance the scale here. We need to look objectively at the real-world operational hazards of running a modern utility company across diverse geographies. $460 million. That is the recently raised low-end liability estimate for the incredibly tragic Marshall wildfire in Colorado. It is a really stark illustration of the immense physical and environmental risks that utility companies are facing today. Breaking down the actual financial realities of this situation, Xcel, alongside a couple of telecom companies, just recently reached a $640 million global settlement with the plaintiffs. For their piece of it, Xcel actually excluded a $290 million charge tied to this settlement from their Q1 ongoing earnings. It's just a very sobering reminder of the kinds of massive, unexpected liabilities that can hit a utility's balance sheet. Let's move to the next slide and see how this builds into their broader corporate strategy. Because despite these very real physical risks, Xcel relies heavily on stringent corporate governance to kind of insulate themselves. They noted in their sustainability report that they've been recognized by Ethisphere as one of the world's most ethical companies every single year since 2020. They're leaning hard on compliance, rigorous auditing, and centralized reporting to maintain their operational integrity across the board. And they're applying that exact same rigorous management style to their supply chain to mitigate execution risks. Because let's be real, you don't just go and order $60 billion worth of utility equipment on Amazon, right? Xcel has already secured 24 gas turbines through Siemens and GE Vernova. They've locked down framework agreements with major engineering and construction vendors. By securing these long-term partnerships early, their massive scale suddenly becomes a huge strategic advantage. It creates these site-to-site crew efficiencies and really helps shield them from inflation and supply chain delays.
Which brings us to the end of our explainer. We've looked at this historic $60 billion build-out. We've seen the insane 20-gigawatt AI and data center pipeline. But we've also seen the heavy leverage required to build it and the very real physical risks of operating it. So my question to you, the focused learner, is this. How do you weigh this massive, unprecedented growth catalyst against the undeniable costs and risks of actually executing the plan? It's a fascinating balancing act, and definitely one we'll be watching closely. Thanks so much for joining me for this explainer, and I'll catch you on the next one.